CNBC senior analyst and commentator and senior advisor to Schroders North America. Ron, what do you make of this Delta variant? Is that the concern, or is the concern that Delta variant is sort of a placeholder for Gamma variant, Epsilon variant, all the other things that we might see if this thing is out there still mutating in the population of unvaccinated people, and what that could do to the economy?
I think all of the above, Eamon, and I think it gives a new definition on Wall Street to so-called delta hedging, which is typically more financially oriented. But in this instance, the market's getting a little weaker amid the concerns that Meg just outlined, that we could see a slower economy if certain regions of the country were forced to radically change their behavior, whether it's in Los Angeles County, whether it's in Missouri, Arkansas, what have you, Nevada even, which is also seeing a surge. It could slow the economy, and we're seeing that also not just domestically, but internationally. And so getting synchronized global economic growth, which was what was hoped for earlier in the year, may become a little more difficult. And I know Art Cashin earlier this morning, my old friend, mentioned this as well, that it's getting more and more credence on Wall Street. So while it's still kind of a wait-and-see situation, the market's nervous about it. But, you know, a day like today is actually a regular day in market history. I got in the business in '84. This is like about a 5-point move at Dow 1000. So it's just a little nervousness. It's not overwhelming.
The other big risk factor out there is inflation. You are an inflation is transitory guy. Are you comfortable with that as we go into the afternoon? I know it's a small move here relatively, percentage terms and everything else, but is there a little worry out there?
Well, I think, you know, it's funny. I mean, and you know this from working in Washington, you know, once everybody kind of gloms on to a concept, they'll wait for a long time before letting go of it, where the markets let go of it a lot more quickly. So lumber has gone from $1,670 per thousand board feet down to $570 or so today. It's down $1,100. And some of those price pressures that we're seeing are already starting to come off, so that the data we've been looking at over the last several weeks and months are really rear view mirror statistics. So I think as you look forward, although there has been a slight upturn in inflation break-evens, a bond market measure of inflation expectations, I do think some of the data suggest that and support the Fed's notion that inflation's transitory, and that some of the big issues around supply chain disruptions and the lack of availability of both workers and parts will pass come September, when we start to see the economy more fully engaged.
Ron, I don't know if you caught our chat with Mike Darda last hour, but the way that he would sort of describe and diagnose the situation is a little bit different than most. He's basically saying, you know, the economic indicators are strong, jobless claims are at lows, you know, even things like consumer confidence are generally looking pretty strong. Meanwhile, the metals gauges, and, you know, again, we've seen data on this today, they're, for the most part, the industrial metals are actually holding up pretty well. We talked yesterday on this program about how junk bond yields are below the inflation rate. So none of those things suggest people think the economy is slowing. So if bond yields are being pushed lower from this liquidity swamp by the Fed, then his point is that this is kind of the opposite of the taper tantrum. This is almost the market saying to the Fed, you're running policy too loose and not tight enough.
Well, you know, it's not just the Fed buying. I mean, and we've heard this from a lot of our own folks, Kelly, that, you know, Jim Cramer and others have talked about the overwhelming demand for treasuries. You know, when you see equity prices go up as much as they have, pension fund managers who have actuarial responsibility to match their books have to buy bonds, you know, tier one capital, if you will, to offset the increase in equities. Foreign buyers, both at the sovereign level and international buyers who are looking for a positive yield from their perspective, have been big buyers as well. So I'm not sure that that's the way I would interpret it. I honestly, yes, obviously with interest rates on a real basis negative, we have very, very easy monetary policy. And there is an argument to be made that if fiscal policy will be flat out, that monetary policy could be dialed back. But I just don't think it's the inflation bugaboo that we had, or boogeyman that we had a couple months ago. I think the reflation trade is still on. I'm less worried about this kind of runaway inflation trade that people were talking about and continue to talk about through today.
Shepard Smith here. Thanks for watching CNBC on YouTube.